Experiment Nation, I have a special gift for you. If you're in the Airbnb space, or if you're thinking of getting into the Airbnb space, you're an operator with multiple units, your first unit, your 100th unit, just about to get into Airbnb, you are going to want to get this blueprint that I put together for you. Now, I want to give context of how this was put together, because sometimes people assemble these ideas and top 10 lists, top 5, top this, and it doesn't have any true valued vetted content. What I've done is I've surrounded myself by the best top short-term rental Airbnb operators in the world. I co-authored a best-selling book with them called Hospitable Host. I've had them on my platform and interviewed them to get the questions that you guys want to learn the most from into the episode, the show, The Real Estate Experiment, as you know. And I've also paid tens and thousands of dollars to be sitting in the room to get these notable insights that we implement ourselves as short-term rental operators. I'm a short-term rental specialist. I'm licensed to do it in the respective markets. You know, we build ours in Georgia. We have a management company ourselves. We're Airbnb superhosts. So we not only talk the talk, but we walk the walk, but we still consistently surround ourselves with the best in the space to get us further ahead. And this is what we've put together, an Airbnb Millionaire Blueprint, where you don't just hear it from me, you hear it, and it's an aggregate list. It's 21 pillars from short-term rental operators worldwide who've implemented this, and it's worked. And these are the exact same way we've been able to get results and get the same results from implementing these insights that I've pulled from multiple faces, right? Some people have tons of arbitrage units like TJ Tijani. Some like Bill Faith have just a few. Some like Michael Shogun has boutique hotels. They've scaled, and whether you have 1 unit, 10 units, or 100th unit, or about to get into your first unit, you're going to want to have this blueprint that you can utilize universally wherever you are in the world. You want to get this. I put together, we took a lot of time to put this together this year after all that we've been implementing in our lab, for you to have a guide that you can leverage, right? That you can use and implement. We've also given and tagged everybody that we've featured in and giving them credit, so you know where the source is coming from, and you can check out their Instagram. You can see that they're vetted individuals that we not only work with and trust but learn from, because sometimes you get a lot of different information, and I want to make sure I give that credit where you can find out that person. And we've also, if they've been on our show, we've also linked the episode within this free blueprint. It's the Airbnb Millionaire Blueprint. Want to make sure you go to experimentrealestate.com. Once you get there, you'll see the pop-up that says I have something for you. Just scroll down, enter your name, enter your email, and we'll get it right sent to you. Don't want to sleep on this. We've been putting this together for quite some time, and I know that it will serve you regardless of where you are in your journey, to have an Airbnb Millionaire Blueprint that has been collectively vetted and has been sourced from operators who are operating at a high scale. Experiment Nation, you are welcome. Make sure to go to experimentrealestate.com and get your Airbnb Millionaire Blueprint, so that you can also scale to the level of experiments that these practitioners like ourselves have done just for you. Experiment Nation, we'll see you on the other side. Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all. Real Estate Experiment, what is happening, y'all? Today, I have the pleasure of being in the lab here with a gentleman who is a practitioner and rolls up his sleeves in the lab the very same way that we do, because he's in the business of solving a problem. Now, I'm very interested of having this gentleman here in the lab with us, because as you can see, Derrick Barker, who is here with us, is the founder of Nectar, right, and the CEO currently. And we're just talking about based out of Atlanta over here. So I'm super excited and geeked out, because you guys know that that's exactly where our turf is when it comes to short-term rentals. And with that said, it's actually going to benefit other short-term rental operators, not limited to, but specifically for our group, because we understand the power of cash flow. That's why we're in this business ourselves. And we have someone here in the lab with us who truly understands how we operate as short-term rental operators and is able to add an extra tool to our tool belt from the financing perspective and come in and help us really, truly accelerate and elevate our business in regardless of where you are and where you stand. And so I want to welcome Derrick to the lab, brother. Welcome, man. How you doing today, man?
Thanks for the welcome. I'm doing pretty good. It's warm out here in Atlanta, 80
It's
degrees
crazy.
today in November, which is crazy. Election day, I have no complaints.
Absolutely, man. Yeah, it's crazy. What a time to be alive. It's already Q4. We're recording this during November here, and it hasn't been the November that I've ever experienced. I was actually in Boston in your neck of the woods. And the reason I say neck of the woods, I'll say is you spent some time there again, fairly getting a nice education to say the very least. And it was like 78, man. It was crazy this past weekend, which is unheard of in November.
That is not what I remember out of Boston.
No, never, man. And it's crazy. So, but before we get into it, because I always geek out having individuals like you step into our lab, as we call it, because experimenting real estate is about taking an experiment, going deep with it, having a proof of concept, wins and losses, and then having a true lab report to be able to share with the people. And that's exactly what you're able to show with us, because you've walked the walk and you talk the talk, right? So I want to take a step back though before we kind of get into what your firm does, what you can offer for investors. I want to go into your story, because I truly believe that we are a reflection of our businesses. And I want to level set by saying that because you've been an investor as well, but you also have this finance background, and you kind of blend them together in your lab. So why don't you take a step back? I know we mentioned Boston. I want to, you went there, you went to school there, you went to Harvard, which is, obviously one of the most respectable universities in the world. And tell us about taking a step back a little bit about your journey. You studied, you got into finance, and then you started investing as well. Like, help us kind of bridge that gap of how you kind of embedded and planted those seeds in your journey as a real estate investor, and now a founder of a startup that's doing very well.
Yeah. Thanks. So I'll go back a little bit further. I'm from Southwest Atlanta, which is an awesome place to be from, an awesome place to grow up. It is a place where that had capital constraints, and you can see it in the built environment. I'll say that, and I'll put a placeholder there for later on in the story. I did matriculate to Harvard. That's where I met my co-founder and partner and wife, Brittany. And we started, I started with a couple of my roommates. The organization got really big. We exited and started buying real estate when I was in college. So that was, so I've been an entrepreneur for a long time. I also played football. I did a couple other things. Left there, and I was a trader at Goldman Sachs. So I was trading fixed income products, structured products at Goldman Sachs. And I saw how creative people can be and how quickly capital can flow to meet the tiniest opportunity. And I was like, this is crazy. People move mountains of money, like huge mountains of money to take advantage of tiny opportunities. When you have huge opportunities out in the market, out in my hometown where I'm from, where you huge opportunities to invest in someplace where you can make a much huger return, and money's not flowing there. Anytime you want to put money there, there's all kinds of barriers to reasons why it's hard to invest in these places where you can actually have a real opportunity. And I saw that, and I continued to build my real estate business and ended up leaving Goldman Sachs to come back home to Atlanta and start a business flipping apartment complexes starting out in my own neighborhood. So this is right after the financial crisis, buying blighted apartment complexes, renovating them, turning them into the nicest apartments on the block, and selling them and making great returns. So that's what I did it with my college redemption originally, and then started building and growing from there. Eventually partnered up with Brittany. After a while of doing that, what we realized is that when you're a real estate entrepreneur, you're a professional, you're a real estate entrepreneur, running that type of business is super capital intensive. and you're always needing money. Like if you want to grow, you want to buy another property, you want to do a renovation, whatever, it's capital intensive, and you can make money, but your cash just inevitably ends up tied up in your properties. It's just something that happens. And still, I was like harkening back to my Goldman days, there's an opportunity here. You have people who are close to opportunity, i.e., I own a property, I know how to make money out of these bricks and sticks. Capital should be there to get to that opportunity, to flow to that opportunity. Again, harkening back to my days at Goldman Sachs, capital can make its way and be creative and find opportunity. And like to me, that was a disconnect. So after doing that for a while, as you know, Brittany started, she ran our short-term rental business. So we had 125 short-term rentals within a portfolio of apartments. We ended up buying and selling about 5,000 units worth of multifamily over the course of 10 years. We started Nectar in order to solve that problem of bringing flexible, common sense capital into this market, into the short-term rental market for the real estate entrepreneurs who know how to make money out of the bricks and sticks in the short-term rental space. They know how to like take a property, whether you own it, whether you manage it, whether you arbitrage it, whether you're a syndicator, the people who are out there on the ground, making money in the space, who have capital needs or close to opportunity. We started Nectar to provide financing to them.
Ooh, man, you're just on a roll. I couldn't stop you, but you dropped so many good gems here, and I want to just take a second. No, this was good because it kind of level sets and brings everything full circle, and we're gonna get to the capital constraint area in the Southwest in a second as well. And I appreciate you putting that as a footnote placeholder there, but just going back for a second, I actually had no idea that you had exited early, which is I'm fascinated about building businesses, buying businesses. Why don't you just take a step back, because we're gonna drill in. Where I gotta tease the people a little bit, but at the same time, it gives some good context, right? So just for the background, and you play football. First of all, hold on. What position did you play? Out of curiosity, I'm just very curious. What position you play in football, and when did you play?
I played cornerback, all Ivy, won a couple Ivy League championships. So
you played quarterback or cornerback? Cornerback. I know cornerback. Okay, you were a cornerback. You play at Harvard?
I did play at Harvard. Yep.
Dude, you're a Renaissance man. Okay, so you played football as well, which is amazing. And then what business did you start with your roommates?
It was called the Veritas Financial Group. And it was effectively, and we got in a lot of trouble doing this, but it was effectively a way to connect. Let me give some context. This is back in 2006. So okay. Wall Street is the thing. I think like 65% of the guys who graduated from Harvard were going to like investment banking and consulting. But there's no business major at Harvard undergrad, but you have Harvard Business School that's full of investors and full of traders and full of like people who know this. So we effectively started a business that created an intro to the financial universe, where Harvard Business School students and professors would teach the undergrads, and then we'd have case competitions, and we'd invite investment bankers to come recruit the undergrads who had learned this like financial curriculum. And we charged the investment banks for each of these events, and they were paying, 2006, they were paying like $10,000, $15,000 per event, each bank. And we have like 3 or 4 banks come and, do it. So we were like, it was great business in 2006. Then there was 2007. And then there was 2008. It wasn't such a great business that anyway, they went from paying to show up to like, we'll give you some pamphlets. So that the exit wasn't as, we didn't get rich off of it. Let's put it that way.
Okay, cool. So, because I wasn't sure if you said you had an exit and then you took how many exits did you have before Goldman Sachs, or was it just that one, or did you have
that? It was that, and then we started exit, like we had to wind that business down. We got into some ultimately, Harvard wasn't happy about some of the things that we were doing, and it was just generally just less profitable of a venture. Like with the financial crisis, we didn't know if Wall Street would exist, but we did know that real estate would exist. And, me and my 2 roommates and my co-founders, Ryan Williams and Charles Cole, awesome guys, love them to death. Ryan's actually the founder of Cadre. which is a real estate marketplace. So
Yeah.
we said, hey, look, this is an opportunity to get in to the real estate game, which no matter what, even if the world ends, there's still going to be like people going to need a place to live. And we thought, or we could get into derivatives, but no one would give us an ISDA. We need like $1 million liquid, and we were broke. So we raised some money from donors who donated to our scholarships, because we were all in financial aid, and used that to start buying real estate in Atlanta. So we'd be flying down to Atlanta, buying real estate. Our senior year, after football season, senior year, I wasn't playing football anymore. We had some time. And that's what we started doing, and started that. And then by the time 2013 came around, we had about 500 units down here in Atlanta. And that's when I left Goldman Sachs at that point to do it full time.
So you graduated in 2010, I think, right?
Yep.
And you were doing this just right around the end of that, or like during it?
I was doing that, like, we were pitching in 2009, and we were like buying in 2010 before graduation. Like,
And what kind of, that's crazy. And so were all your roommates from Atlanta, or is there a reason, like, did you convince them to invest there, or what was
I
why
mean,
Atlanta?
Ryan's from Baton Rouge, Louisiana. Charles is from Gary, Indiana. So if you have to choose between the three, from an investment perspective, Atlanta had as many Fortune 500 companies. They had the third most Fortune 500 companies in the country. And the prices, they were around the same prices as Cleveland in terms of housing prices, which was a place where the demographics were getting worse, like the population was declining, didn't have any Fortune 500 companies. Atlanta, the population was increasing, businesses were moving there, and it just made sense. And so we did an analysis, and we were like, well, where can we afford? Like, we couldn't afford to buy stuff in Boston. We were like, if we can raise some money, our dollars will go further in Atlanta. Plus, we have a free car in house, because I could, can sleep at my dad's couch or my grandma's basement while we're going down there doing the diligence, and borrow somebody's car and go buy some property. So
Wait, and just so I understand, we're gonna get into rent and Nectar. I'm just very curious. How did you what kind of properties were you buying, and what was the structure that you went in? Was it traditional 20% down single family homes, or were you thinking like, no, let's buy like multiple doors?
originally, the first two deals we did, we just bought single family houses cash. We bought, and then we raised a small fund, and we're buying single family properties cash, because we were 22 with no balance. We can get mortgages, and we were rehabbing them and flipping them, and then
oh my god! And you guys did you have this background, like, because this doesn't seem like something we wake up, hey, let's do it. Over, like, what was the process? I mean, you guys are smart guys. What was, hey, Derrick, you're gonna handle the analysis and find us a really good realtor, or actually, no, we're gonna do this off market. Ryan, you're gonna do this. Like, how did you guys divide and conquer? Because this seems like a very quick, like, okay, we're gonna do this, and let's conquer. Like, what was the blueprint?
we were incredibly hungry, incredibly driven. We believed we could do anything in the world, and we were so naive. We had no clue what we were doing. So we were just we're just kind of out there just trying stuff, really. And like we did an analysis. We were like, it was always, hey, we're Harvard students trying to do something. Can you give us some advice? We reached out to a bunch of people in the Harvard network. People like helped us, to be honest, just because they're like, who are these young, 15-year-old looking kids out here trying to do something? But we went, we just got a compelling pitch. Hey, you can invest your money in Atlanta in like nice neighborhoods, nice properties at $150,000, $200,000. And you go to these New York investors who, by the way, they've donated to Harvard to fund our scholarship. So they were already like, they had money, and they were already like,
They're invested.
They invested in our education even before knowing us. So like, it was it was a soft target, let's say. They gave us a little bit of money to buy in what we thought was maybe the bottom. It wasn't the bottom, but we thought it was like, couldn't go that much lower. It went lower. But like, so we went, we're buying things, and We were trying to rehab things. We didn't know what we were doing, and we were not doing a great job, but the market just went up eventually. And we learned through the school of the hard knocks. So out there just scrapping and just like trying things. And then after a couple of years of doing it, we just learned a bunch of lessons, and, you know, and then the market went up. So the combination of being in there, there's no better way to learn than to be in there and to like take some L's and to like and have the world really show you. Like,
you see the sign, you see the sign behind me? For those of you who are listening, what does that say? Experiment, fail, learn, repeat. That's why Derrick's in the lab right now, because of that. And I really want to, I think it's really important to get that background, because, you know, you might look at it and you look at, you reverse, you zoom out a bit and you're like, oh, well, yeah, like Derrick, like, okay, like, you know, finance, trader, you know, Harvard. And you start like putting, you know, this idea together of like how Derrick got here. But it goes back to the fundamentals of why we actually have this show, is you have to roll up your sleeves and take action, fail, learn from it, repeat. So now I want to transition to, because this is really going to,
I want to get this just, and you can cut this out if it takes too long, but even the Goldman thing, like I didn't get, like my first year, after my first year at Harvard, I can get any job. I worked at a student-run nonprofit summer camp. That was one of the reasons we started Veritas Financial Group, because no one would give us jobs. 3 young Black kids from like, you know, working class families that do nothing about finance. We started BFG because we were like, look, there are a bunch of people over there on the other side of that river who worked in finance, who are the smartest people, and they're at Harvard Business School. We're going to find some way to convince them to teach us how to get a job, that we're going to get some way to get connected to all those people on Wall Street, because we didn't know anybody. We started a whole organization, connecting a whole bunch of people. And then guess what? Now we know all the people. We knew all the recruiters. We know all the people. Like, and so like, I didn't have the background and the pedigree, like, you know what I'm saying? We didn't have the, you know, we went and and then even after that, my sophomore year, we, you know, ended up getting had a football connection. That's like go, and then it ended up getting a job at Fidelity, and it was scrapping, and it was like hustling, and it was using my brain to figure out how do I get there in a way that other people aren't getting there. I'm not going to make it the same way everybody else is going to make it, because I just don't have that. I don't have those cards to play. So you know, figure out how to be creative with the cards you got.
Figure out how to be creative with the cards you got. That's probably honestly one of the best advice you get here, because there's always like, what is the one thing? No, I would run with that. Like, figure out the game with the best cards you got, man. Damn, that's good. Listen, are you kidding me? Cut this out. This is where the juice is. This is how we got here. And the reason it's so important, because it gives us context to when you're talking about opportunity, when you're talking about capital constraint, when you're talking about, you know, real estate being capital extensive. It's really important for us to understand how you solve problems, right? How you've always solved problems, and how this is actually going to be critical into the problems that we face today as investors. So for the sake of the transitioning of like your experiments, you did all this, you did the flipping thing. How did you get into the short-term rental? Because that's always, you know, an interesting, you know, anytime I have someone who's in the short-term rental space, I'm very curious as to how they got introduced to it, because we all get introduced to it or fall into it in very different ways.
Yeah. So we were flipping apartment complexes. So like I literally went back to like, we were in like working class neighborhoods. We were buying properties that were not cash flowing. We were like renovating them, and we were like getting them stabilized. As soon as they're stabilized, we were selling them because we really had to. They were taking all our cash to do the next deal. So we didn't have cash flow. Like we didn't have, it was very up and down type thing. And even if we did have cash flow, it's like you get a couple thousand coming in, but you got to meet this down payment. And Brittany she was running our small property portfolio. So anything 50 units or less. And we were recently married. And she's like, left her high-paying corporate America job. I left my high-paying corporate America job. And she was like, we got to figure out how to get some cash, like in between these deals. And we were like, okay, well, what can we do? We have all these properties. And we were like, well, why don't we just take a unit? We heard about what was going on in Airbnb. We had used Airbnb to travel. Like, well, what if we just take one of these units? If the numbers are right, like we didn't even believe it. We were like, this isn't even possible, but we can try it out on one unit and just see if the numbers work.
Yeah.
And so we took a unit in one of our apartments, put it up on Airbnb. Really, I say I'm using we really loosely. It was like Brittany. I was the muscle.
Shout out to Brittany. Shout out to Brittany.
I know she'll be on the next podcast. She told me where to put the furniture and I like help move. But like, but yeah, we tried it once and you're like, dang, we made $3,000 this month off this one unit. We got a bunch of units. Let's just do this.
What year was this?
2016 or 17. Into 2015, yeah, because yeah.
So you got a taste, and you ran this test. You ran another experiment, right? Mm-hmm. Right? We're like calculated experiment, and you got a return on that, and so you doubled down.
Double, triple, quadruple, yeah. So, grew quickly. So yeah.
And so and this is gonna connect the dots as how we got here today. You were buying these cash again with the money that you, again, just to level set with your co-founders, right? Your boys from Harvard. You didn't have W-2s, etc. So you bought cash with the money that you kind of raised with the folks that had paid for your financial aid. Then you were able to get some equity in there. Were you then still doing the exact same thing? How did you, or at what point, how did you transition from buying everything cash? Because we know that now that's a lot of, you talk about return on equity, right? Like that's a lot of cash tied into one. So how did you make that jump from going to like 500 units when you're only operating with cash?
I mean, quickly, like, our whole story is just progression. Like we had problems, we like outgrew them. So we had like mixed results, like, because we were learning how to do rehab, like we didn't know anything about rehab. But we like did that. And then mind you, we're graduating from college, starting jobs, me and Ryan at Goldman Sachs, Charles at Bain. So like, these are real jobs where you're working real hours. Like Goldman isn't, like, you don't have a lot of downtime, but we're still making it happen. And we're like, we just can't be flipping bunch of these little properties. So we then say, okay, well, look, we can buy a quadruplex. And at the time we were like, if we can just get a little bit of actual just loan, like 70% loan, we can get like 25% cash on cash. Because remember, this is back 2011, 2012, and like, not the hottest neighborhood in Atlanta. So we started moving to quads, and then did one and it worked. Then we sold all those single family and then bought a portfolio of quads. And I was like, wow, this is good. Renovated those, sold them. It's like, wow, see, these things selling a cap rate. At first they were just selling like price per pound unit, then they're selling a cap rate. This is a good business model. Then we did that, bought another portfolio of like, condos, broken condo deal. Flipped it in like 6 months, made like a 300% IRR. So you're like, started quick, and this is levered. So we like quickly moved to like, we started to flipping small multifamily portfolios, small multifamily, then got our first apartment complex, 50 units in College Park. Similar, like, renovated that. There was a fire in one of the buildings. We took, used the insurance money, got 8 units up, renovated. This is what you can do in this unit. Boom, like that, got that, flipped into something else. Partnered with a local family in Atlanta where the patriarch was, getting older in age, and took their portfolio, became asset manager. Partnered with them on a deal, bought a whole bunch of units, bought like maybe 3 or 4 apartment complexes with them. Did those same thing, renovated them. Took the properties up in value. They liked what we were doing and those deals that we partnered with them on. And they said, hey, why don't you asset manage our whole portfolio? And they had thousands of units. So then we got big portfolio experience. And then we renovated a lot of their properties and like improved their asset value and their NOI. And then we took that track record and just kept going.
So you're the proof or your core competency, you would say, is value add, right? Like you're not just buying turnkey, or you're always looking for an opportunity of value add. Can you tell us why?
This is 2010, 11, 12, 13, 14. I'm from the Southwest Atlanta, the center of mortgage crisis, of like mortgage fraud and like, foreclosure. Like, there was blight. there was the need. I was the first person from my high school to ever go to Harvard. I went to Goldman where money was just sloshing around. And I was like, if I'm going to be in this position, I'm going to go back and fix some of the things that are broken and use that opportunity. So yeah, that's what I was doing. Cause and this is another thing that's just something about just like my internal drive. I wasn't going to give all of my soul and time and life to increasing the shareholder value of Goldman Sachs shareholders. You know what I'm saying? When I was going to do that because it was great. Got nothing bad to say about Goldman. Great opportunities. It was a great place. I learned a lot. They gave me more responsibility than you should give a 22 or 23-year-old. And it was great. I had a great time. But I was like, I'm going to take this experience and come back home to Southwest to Atlanta, where there needs to be someone putting money into these properties where you have good people and good families that just want a decent place to live. So that's why I got into value add, and then I got good at it. And it turns out you can generate returns. Turns out you can go into like the wrong side of the tracks, i.e. the Black neighborhoods. I don't know if I'm supposed to say that, and like still put money in. And guess what? People will pay the rents because people have jobs and they want to live someplace nice. And like, if they want someplace nice, then like, and so like that was a niche that we just hit. It worked. And then we got good at it, and we had the infrastructure and we had the contacts. And so that's what we did. Even then, we eventually got into doing turnkey stuff because it turns out renovations are just actually hard. And then like, people start bidding stuff up, and, we used to be able to buy things for 13,000, 20,000 a unit, and those same bricks and sticks in that same neighborhood, now trading for 70,000. So we eventually, our strategy shifted over time.
Yeah. And obviously a company was born out of it, which is Nectar, which is why we're even here. And, can you please let us know who Nectar was built for? I know you mentioned it in the beginning, but I really want to make it super clear of, when you built Nectar, what problem were you solving? And I want to be super clear when you answer this question that, we're talking about what problem are you solving and were you solving with as it relative to what is out there in the marketplace. I think it's really important for us to connect the dots of like what is out there for us today, and then what Nectar kind of brings to the table that is not on the menu.
Yeah. So there are a world of people out there, experienced real estate entrepreneurs who know how to go and take a property and make it make money. Right. So like those are the people who create the built environment that we live in. They create all the experiences that we have in the built environment. Those are the people who make it happen. Right. And they deserve, and that's hard work. It's something everybody can't do. Like you can't just throw cash and make that happen. It takes it takes expertise. And I believe, and like it's hard, it's capital intensive to do that. And that's where you do that and you can generate cash flow. You go, you do something, you improve something, whether it be through hospitality, through furnishing, through actual CapEx, and you do great operations, and it makes cash flow. We created Nectar so that the people who are the entrepreneurs that are owning or managing or arbitraging or like syndicating, have cash flow, they generate cash flowing assets, create cash flowing assets to provide them the capital they need to operate their business, so that they don't have to, every time they need money, go out and raise equity from equity investors and give up all of their upside, or 70% of their upside. But they don't have to go through to empty out every single dime from their pocket to make this renovation happen, because ultimately, and then wait years and years for it to come back in, small increments in cash flow. Because that's what I had to do. Every time I had some money, I had to empty it all out to buy the next property or to finish the renovation, or I had to go to the other side of town and get equity investors to dilute myself. So, I don't know if that's simple enough, but we created Nectar to provide cash flow based financing. If we have cash flow, instead of having it drip out over the 5 years, we can give it to you now, and you can use that to generate more income, to buy more assets, to improve your current assets.
Now, excellent. Now, how long of a runway do I need to have, right? Is it 1 year? Is it 2 years? Is it 6 months? Is it 5 years, right? What does it look like if I come to Nectar and I say, hey, listen, I got this cash flowing asset, whether it's a quad, whether it's a 50 unit, whether it's 1 unit. Can you touch on that a little bit?
Yeah. And let me just say, we will finance a management company. We'll finance a syndication. We'll finance a property you own. We'll finance asset management fees or developer fees, any just cash flowing, anything where we can just say, hey, there's cash flow here. In terms of like the track record you need, we're focused mostly on people who have a couple years of experience at least. You know, they actually know what they're doing. You know, they've gone through a whole cycle, at least a whole year. They know what seasonality is, you know what I'm saying? And so they have a little bit of experience. They have some, some cash flow coming in. The properties, we ideally like to see at least 1 year of track record, but that's not a hard requirement. So if you have, if you have a couple of years experience, 3 years experience is really like, that's where we're most comfortable. And you have like, 4 or 5 properties, but then you have this, a couple that are newer. We'll look at newer properties. We'll even look at new acquisitions. But we really want to, like, we're betting on the sponsors. We're betting on the experience of the people who are running the project. And so we want to see some experience.
Got it. Now, what does that look like tactically? Because you say, okay, this is, it's capital, it's cash flow based financing, right? So let's walk through a case study of where, I'm someone who, let's say I got 5 units under my belt, some are managed, some I own, and I come to you and I do what next in order to be able to get and, qualify for this kind of cash flow based financing?
So our process is pretty quick. It's like a P&L. That's what we need. Get us your P&L. If you have a T12 broken out by month, profit and loss statement. So your income minus your expenses. And then we can turn that around the next day. We'll tell you how much money you can make, or how much money we can get you. Then after that, if that makes sense, then we'll go through a diligence process where really we're just verifying that the numbers you send us are true. You can't just send a spreadsheet and that's not due in like sending you $100,000 without doing any, firming. But that's it. Send us over a P&L. We'll get you the numbers. We might ask some questions because sometimes people have like, a big, sometimes like, oh, I added a pool. So it's like, okay, and it's cost $50,000. And so we might have to like verify things. I don't want to hold that against you. That's not going to be a recurring expense. So maybe we'll have some questions to just verify if something's recurring, and then we get back to you the next. But typically it's 24 hours. We can get back to you with how much money that we can get you. And then if that's all good, then we just verify things, and then boom, we typically can be in and out 5-6 days.
Excellent. And then at that point, let's say you do give me the 100K, or let's say it's 50K, whatever that amount is. And I'm assuming that amount, well, let's go there for a second. What is the amount that you give me based on? Is it like, is there a multiple of some kind that you're using, et cetera? How do you define that?
So we're looking at a coverage ratio. So we're trying to see like how much, we're looking at your net cash flow. Mm-hmm. You're making $5,000 a month. We want to make sure that you're paying us and then have some cushion, right? So we, at least 1.5, 1.6. That's going to be like, max. That means for every dollar that you owe us, you are making $1.60 at least. That's like very max that we'll do. And then, and we look at and that's going to go up and down depending on, the experience, how stable the cash flow is, things like that. So there are various risk factors.
Are you looking at my credit? Or are you looking at if I have a W-2 as well? Like, what things are you possibly looking at as well when you factor that decision? Just so we're super clear for the audience.
Yeah, we're looking at the net cash flow that's coming off of this company, the property owning entity, the management company, whatever it is. We're looking at that. Like we're not making our decision based off of credit. We're not looking at your W-2 income at all. If you have it, cool. We honestly, most of the people that we work with don't have W-2 income. If some do, there's no problem with that. It's just, we are cash flow based lending. So that's what we're going to be backed by. We're going to say, hey, you're making this much money. You can afford to pay us $2,000 a month for the next 5 years. So if you can afford to pay us $2,000 in the next 5 years, we can give you that $2,000 a month for the next 5 years minus the discount. And that's kind of how we do it.
Got it. And that upfront cash flow, that the cash that they're looking for, it's a cash advance essentially based on your proven track record of your current portfolio and properties or management or service, right? If someone's listening and be like, okay, so Derrick, tell me why, I shouldn't get a debt service DSCR ratio, debt service coverage ratio loan, as we know in the short-term rental space is a very common tool. Help us either understand what gaps you're covering, help us understand what the differences are maybe, or help us even understand why the two can coexist, but maybe you're just highlighting to us that there is an extra additional tool that you can have on your tool belt.
That's a great question. Thanks for asking. So you should get a debt service coverage ratio loan. We're structured to work with any capital stack. So what that means is you have your loan in place, your mortgage in place. We're not asset-based lenders. We're not going to have a lien on your property. So we're not going to interfere with your mortgage. And because the mortgage has a lien on your property, their capital is going to be cheaper than ours. Because if you don't pay them, they'll take your house. If you don't pay us, we're going to be really sad, and we'll go out. I mean, we have other remedies. We'll go after, we have a lien in their business. We can go after, other assets if you're do something fraudulent. But that's the difference. We work on top of a mortgage to provide additional financing if you need cash for a down payment, for instance, or a renovation. Say you have a property, you have a low interest rate already because you got the mortgage a year or so ago, and you need to do some upgrades to make sure that the property is still fresh. Well, you can refi and get rid of your cheap interest rate, or you can come to us. We'll get you the cash quick. It'll be a shorter term. You'll pay us back less because it's a shorter term. That way, and you can keep your cheap mortgage and cheap mortgage financing.
Got it. And then, that's a great response. And then question that someone might be listening as they're listening to this is, and again, I think what's really important, the reason I'm going with these questions is I'm thinking of, how do I, add this to my tool belt, and how does it compare to the things I have on my tool belt? So I think it's really important to kind of level set, because as we were talking about this offline too, it's in order for someone to use a tool, they need to know when they need to use it. So one might also ask the question is, I've heard of business lines of credit. Can you tell me, Derrick, how this might be different, similar, or again, can be used as a collective, right? Or not? Let us know.
So we are custom designed for people who run real estate businesses, specifically for people in the short-term rental space. So a business line of credit is great if you can get it. But they're not underwriting you in the same way that we are. And so it's just going to be harder to get. And then they're probably going to give you less money. We understand the business. We understand the business model. We understand it very well. So we're typically able to just underwrite you quicker, because we already have a thesis on the market. We already know how the business works. We're typically able to get you more. And then our cost of capital is either comparable or sometimes cheaper.
Yeah.
If you maybe Chase, depending on how much money, if they give you less leverage, we're going to be comparable, sometimes cheaper, sometimes more expensive, depending on your exact specific situation.
Yeah.
But that I'd say we're similar. So either we've taken out people's merchant cash advances, for instance. So we've had clients who have a perfectly good business and they've been funding growth through merchant cash advances. We're an order of magnitude cheaper. Our terms are an order of magnitude better. And we give much longer terms, so your payments are shorter. So we've been able to consolidate and have them pay off all these honestly predatory merchant cash advances in order to get more programmatic financing that
Yeah.
works with their business. Or
Yeah.
yeah.
Yeah, and I think it's really important what you're highlighting, Derek, is to understand, we talk about this with the credit unions all the time, or your local bank. It's, have a partner that truly understands, right? The reason why you get better rates at maybe a credit union, et cetera, is because they know who you are, they know what you've done, they see your book of business, right? And this is what we're saying is Nectar is a vendor that understands what cash flow means in the short-term rental space. And this to be true, because if everybody understood in the multifamily space how the benefits of short-term rentals, you'd have a lot of people doing what essentially Derrick did, right? Was like, why don't we apply this economies of scale in apartments? And we know there's a few people who understand this at the boutique hotel level who are really maximizing the forced appreciation because they understand the commercial real estate and they understand also the opportunity to truly arbitrage a unit at scale, right? And get more. And so if you can find a partner that can also that understands what your cash flow means, understand what it looks like on paper, and then based on those terms can lend to you, then that's how you're able to use a company like Nectar that does cash flow based advances essentially at that's much cheaper. I think what we're talking about there, Derrick, is, when you're using like a short-term high interest lender, like and we talked about this, there's like Cabbage, there's like PayPal, there's a bunch of different ones. Their terms are not for as long. I believe it's sometimes like 12 months, sometimes it's 6 months, sometimes it's 18. But
Right.
yours are what? They extend up to like what, 5 years maybe?
We'll go 5 years. And they try to
Yeah.
trick you by saying, oh, it's a 4% fee and like revenue based, but they're charging you like a 300% interest, because it's short term and they take a bunch of your cash, a bunch of your revenue. That's really hard on the cash flow. We want you to have cash flow. And we want you to have upside too. So, and we know that if you have a property, it's going to be there. Like we're okay going out longer than 6 months, longer than a year. We're okay going out, 3, 4, 5 years. So you can get the cash you need, invest properly, and be able to pay it back over time. If you have 10 properties, we work with people who have portfolios, have 10 properties. We want you to have 12 properties. So sell some of your cash flow, buy 12 properties. Net, your portfolio is making more, and you keep all that upside instead of going to investors where you have to, give up the upside.
Got it. So I truly believe, and this is why I really want to be transparent with Experiment Nation, because I believe when you're able to understand how someone does business, that's why you'll do business with them. That's why I know you and I have talked a lot about branding, is like show people over the shoulder what it is that you're doing, right? And so in traditional lending, we understand that, hey, yeah, the bank's going to give me 80%. I'm going to put down 20. Yes, I'm going to pay principal and interest. The bank makes billions of dollars with interest. They'll even sell that loan out, right? And make money out of it, which is okay because they lent you the money. So you win, the bank wins, right? And so I think we can understand that at a fundamental level. There might be some people who are listening to this and be like, okay, I don't understand like, how you work and how you make money, how Nectar makes money. And I think that's important to display to people both sides so they understand, oh, Nectar is my partner. They win because of X and I win because I get a cash advance. How would you describe how you win as a business operator of Nectar so that people can understand how it's a win-win situation?
Yeah. How we win is like, you pay us back. But like effectively, we're buying your cash, we're providing cash flow based financing, and we charge like an annual financing effectively. It's, you're paying equal monthly payments, but there's a fee in there. It's typically between 8 and 15% annually. So that's kind of that's how we do it. And that 8 and 15 is going to depend on, the various risk factors of your business. And that's how we make money. We'll make a little, we make a little bit of that margin. And then we really make money by doing repeat business, by like giving you the $100,000 advance, and then you grow your portfolio, and then give you $150,000 advance, and then a $500,000 advance. And that's, and then we all grow together. Our portfolio is bigger, your portfolio is bigger, and we're all happy.
No, I love that. And absolutely, I mean, that's how it should be, right? I mean, that you guys grow at scale, we win, you help the little guy become the big guy, and you kind of foster that relationship as well. And on that fee, just so we understand that, do you guys bake it into the monthly payment as well, the way a bank would do it as well?
We do. We bake it into the monthly payment.
Yeah.
The difference between us and the bank is there's no lump sum payment at the end. There's no, and that's like that's crucial because there's no refinance risk. You don't have to worry about, is my property going to go up and down in value, or am I going to be able to refi later? You just, we say how much can you pay monthly? You and we're saying you're going to pay us this amount monthly for 3 years, 36 months, and after that, it's over. There's no lump sum payment. It's just, we go away.
Got it. And so for our listeners, because this is, I mean, experimentation. I can't tell you how many times like I listen to, I have a guest that comes on here and I'm like, hold on, I'm doing this, right? We've seen that with like infinite banking. We've seen that with short-term rentals. Like literally, it's you guys, experimentation knows that I also walk the walk. So, if I'm looking at to do this, like what are the things that I should be thinking about of, when I think of Nectar, and I think of, hey, I need to do X, this is what Nectar can bring for me. Can you just quickly just bullet point list some things, right? We talked about, what could I do with this money possibly? And I'm just trying to, I know this might seem like a very fundamental question, but is there a limit as to what I can do with this money, right? What are some things giving insight? Can I use it for designing? Can I use it to buy another property? Can I use it to, like, what are some case studies that you've seen, or how people are using this cash flow based advance for, so I can give experimentation insight as to, oh, maybe I could use it for that?
I'll give a short answer and a long answer. The short answer is any business use, period. So that's the short answer. It's a slightly different structure if you want to use it for a down payment, because banks don't want to see you borrowing a down payment as a season. So we just have a different structure where we effectively we take a membership interest in the next property owning entity that you pay off when you pay us back. So it's the same for you economically. You still pay us off and you own 100%, but we have to structure it that way and to get around that, down payment issue. But you can use it for any business case. We've had people use it to buy other management companies. We've had people use it to pay off expensive, hard money loans or MCAs. We've had people buy properties, that people do renovations, people finish renovations that have gone over budget. It's been a big use case. People have added pools, furniture. We had a guy who, he had a portfolio and he wanted to grow his portfolio without having, and he has a portfolio with equity investors. He wanted to buy other properties without having to raise more money. So he just got an advance in the cash flow. And now with the same equity he already raised, he went from 10 properties to 13 properties. So, these are, different use cases. When
that comes to mind too, as you're speaking, is like, we talked a lot about rental arbitrage, and a lot of people are like, we've had TJ Tijani step into the lab and says that he uses rental arbitrage to own. So if you have a cash flowing rental arbitrage business, it sounds like you could very well get that advance because you have a proof of concept of people who are paying you. If you're a co-hosting, right, you could use that to get an advance to then leverage to then buy. Am I correct?
100%. Yeah, I should have mentioned that. We've had people do that. We had somebody get an advance on the rental arbitrage income to buy the property that they were rental arbitrage.
Oh, wow. I like that. Dude, I feel like I could have you in here forever talking about this case studies. I feel like you should, that's another thing we need to talk about, right? Doing case studies, because that's really interesting. But listen, I know we're on top of the hour, and I think we could go on and on. Definitely look out for Derrick and Brittany, what they've built together, and along with all the partners that came along within that journey to make it happen and become what it is today. And I can't tell you enough how, we're going to be definitely tapping into this ourselves, Derrick. And obviously, I trust that experimentation hopefully can do the same and add that to their tool belt. But, Derrick, you've done so much, and I'm going to let you go. What's the, with your story, if you have one piece of advice or mantra that you think you would say you live by, in all your experiments and all that you do and all that you've done, what would you say that is if you want to leave experimentation with words of wisdom?
Oh man, I don't know. I don't know. You put me on the spot here. I say, dream big, take small steps today. It's like, if you have a goal, go after exactly the goals you want. Like no big, but like just today, take the one step, put one foot in front of the other. And it's gonna be hard no matter what. Like doing things small is gonna be hard, and doing things big is gonna be hard. So firstly, just be okay with the journey. Like, so it's, don't start off thinking, oh, it's gonna be sunshine and roses and butterflies. It will be, and there's gonna be sunshine and roses and butterflies, even on hard days, and they're gonna come. They're in your future. So you might as well go for the real dream. Go big. I don't know.
Man, love that answer, bro. Love that answer. Listen, guys, if you're driving, you guys already know the rules. Keep your hands on the steering wheel. We'll include everything in the show notes. And of course, Derrick, I want to leave you with, where can people, tune in and actually, tap into what you're offering? I know the website, but want to let the people know where we can find you.
Yeah. Usenectar.com. USENECTAR. Usenectar.com. The website will be the easiest way. Just go on, get an estimate. If you drop in your P&L, we'll get you a quote the next day. We can hop on the phone, schedule a call with us. We can talk through, give you a capital stack consult. We can help you get your DSCR loan in place and get you a Nectar financing. Love to chat with you and see how we can help.
You bet. We will. We'll be on that. And again, usenectar.com. And just like that, Experiment Nation, thank you, Derrick, for coming. We are out.